U.S. natural gas futures dipped toward $3 after a smaller-than-expected storage drawdown reported by the EIA. Utilities withdrew 30 billion cubic feet of natural gas in the week ending November 29, below market expectations of a 43 billion cubic feet draw, leaving inventories at 3,937 billion cubic feet. Natural gas prices are down over 8% this week, as forecasts suggest a shift from colder-than-normal weather through December 7 to warmer-than-normal conditions afterward, likely reducing heating demand. The eastern U.S. is currently facing frosty weather, driving strong natural gas demand through the weekend as heating needs surge. However, this trend is expected to shift as temperatures rise into the 40s to 60s early next week, easing demand to more moderate levels. Adding to the bearish outlook, long-range weather models continue to lean warmer, indicating reduced heating needs over the 8 to 15-day period. This trend is likely to exert additional downward pressure on natural gas prices, with milder conditions dampening demand expectations for December. On the supply side, December production in the United States rose to 102.3 from 101.5 billion cubic feet per day in November but remained below the record 105.3 billion cubic feet per day from last December. Analysts anticipate production increases in 2025, driven by stronger LNG export demand and recovering prices. Supporting this, feed gas volumes to major LNG export plants averaged 14.2 billion cubic feet per day in early December, up from November's 13.6 billion cubic feet per day, approaching record levels. Across the Atlantic, Europe faces heightened energy uncertainty as the expiration of the Russia-Ukraine pipeline agreement looms. Should Ukraine cease gas transshipments from Russia after December 31, countries heavily dependent on this route, such as Austria and Hungary, could face significant supply disruptions during the peak demand season. This scenario highlights the critical role of U.S. LNG exports in Europe's energy strategy as the region works to diversify away from Russian supplies. For American producers, this geopolitical tension could translate into opportunities for increased export volumes, reinforcing U.S. LNG's position in the global market. As Europe intensifies efforts to secure alternative energy sources, demand for U.S. nat gas is poised to strengthen, potentially offsetting some of the domestic market's seasonal price pressures. This situation could escalate dramatically if a harsh cold snap finally descends upon U.S. soil, amplifying demand and intensifying market pressures. The market appears set to end the week on a bearish note, with prices staying confined to the short-term retracement range of $3.10 to $3. Notably, prices continue to trade below the 50-day moving average at $3.09, reinforcing a key resistance level that is limiting upward momentum and suggesting persistent selling pressure. Since late October, the 50-day moving average has acted as a reliable support level for natural gas prices. However, its role as a solid foundation is now in doubt. The key factor driving this uncertainty is the January weather forecast, with traders closely monitoring any indications of a return to colder conditions. If frigid temperatures emerge, prices could gain upward momentum, targeting the $3.50 level. On the other hand, if warmer trends persist, prices may slide lower, potentially establishing $3 as a critical resistance barrier instead of support. Please like, subscribe, and comment to support the channel. See you in the next one.